This Apple downgrade, 96 pages it takes HSBC to tell us that the core growth of the hardware unit, that their biggest days of growth are over.
I just don't buy that. I've had a couple of experiences the last couple of weeks, Carl, and I'm a believer like Peter Lynch in using your eyes. And I wanted to buy some new Apple product, and the two stores I wanted to buy them in had been demolished. I mean, just demolished. And what they're doing is they're building bigger stores so they can service more people. And the reality is that the continuing revenues of Apple, I think, are going to be extraordinarily good. I think the biggest threat to the stock actually is the 30% fee on the App Store. But it's clear that Apple wants to spend money increasing its facing with the consumer, and that sells more hardware, but more importantly, it sells more recurring revenue. And that's the stuff of higher multiples, the Saturday and Sunday cash flows.
When you say the 30% fee in the App Store, you're referring to the Supreme Court case that's being heard right now? Why do you think that's the biggest threat?
Well, I think that that's a pretty high number. And some people, Morgan, might think that that signals monopoly profits. Really, Apple controls 100% of the market. You can't have an app without going to Apple. But the App Store, I think, is one of the reasons why the stock has gone parabolic over the last few years. It's been a marvelous way to collect revenue. If you were back 10 years ago, you couldn't have possibly forecast that the App Store was going to exist. It's all cash flow. The cost of the App Store once it's established is virtually nil. So each incremental dollar probably has a 90% marginal profit factor. And to me, that's the risk. I think I can live with it. The company does too good a job for the consumer. I think it's recommended right now or recognized as the leading consumer brand in the world. The multiple's not excessive. It really trades at a consumer product multiple like a General Mills, Kellogg, or Procter & Gamble, and it's a much, much better business model. The return on capital in Apple is just mind-boggling.
How is tech fitting in your overall market thesis right now, Saira? Because it's, well, when I say tech, we should really parse it down because there's a big difference between semis and some other elements of tech right now.
Yeah, I mean, I think we need to be very cautious about how much we pay for these technology companies going forward. There's some great companies with strong structural growth in areas like e-commerce payments that we can pay still good multiples for, but these premium valued technology companies where people were willing to pay high multiples in the past, we don't think that's going to be the case going forward. Returns on the markets are likely going to be compressed. We're probably in a trading range for the time being, and we need to be very sensitive of how much we pay for these strong structural growth companies.
Can you be specific on what you mean when you point to those examples? Like what names?
So we think, for example, like PayPal, Visa, MasterCard, these are technology companies with a lot of tailwinds that aren't trading at very expensive valuations, but some of these FANG stocks, we think you need to be careful now about how much you pay for it, whether their growth is really sustainable over a number of years and at what level.